The webinar will begin in 3 minutes. The webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar titled 3 Overlooked Tax Cut and Jobs Act Changes. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limberg, and regularly speaks at industry events. His new book, Sellout, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is available now on Amazon. But before we turn it over to Linus, let's vote on next month's webinar topic. I'm going to launch a poll, and we'll give you about a minute to vote on next month's topic. We'll give you about 15 more seconds. For those who haven't had the opportunity to vote and would like to do so, go ahead and do so now, please. All right, it looks like trust as a beneficiary of a qualified account wins the poll for today. So the next month's topic will be trust as beneficiary for a qualified account. And now I'll turn it over to Lennis.
Thanks, Jennifer. Good morning or good afternoon, everyone. We're going to talk today about 3 overlooked Tax Cut and Jobs Act changes. All of you are aware that at the end of 2017, Congress and the President got together and made significant changes to the federal income tax structure. They made more changes than that, but income tax changes were perhaps the biggest changes. And the tax landscape changed for both individuals and business taxpayers. We've talked about that kind of stuff before. But inside of the Tax Cut and Jobs Act package were 3 changes that I know we haven't emphasized, and perhaps you aren't that familiar with, and certainly our clients aren't that familiar with, that we thought we'd talk about today. We're going to talk first of all about the extended rollover rules for plan loan offsets from qualified plans like 403B or 401k plans. We'll talk about the changes to the kiddie tax rules, and then we'll talk about something that we get asked about at advanced underwriting consultants quite a bit, the loss of the tax deduction for investment account advisory fees. So let's go ahead and get started. Let's talk about the changes in plan loan offsets and the rollover options. So just as an overview of plan loans, a qualified plan, an employer-sponsored plan, may provide for loans to the participants if the plan document permits. Now, this isn't IRA loans. This is employer-sponsored plan loans. Those kinds of loans are allowed if the plan document permits, and in general, the most that can be borrowed is $50,000 or less, depending on the participant's account balance and circumstances. These are most commonly features in 401k plans or 403b plans. The plan document itself must specify the procedures for applying for a loan and the repayment terms, but generally the loans have to be repaid within a 5-year period. And typically the loan repayment is out of payroll deduct. And that makes sense because the participant is working for the employer at the time the loan is applied for, and repaying out of payroll makes it kind of automatic. So that's typically how these plan loans work. And so if somebody defaults on a loan for whatever reason while they're still in service and perhaps younger than 59 and a half, the loan default will be considered to be a deemed distribution, and it will be taxable. And a deemed distribution is not eligible for rollover. And the reason it's not eligible for rollover is the plan participant is not entitled to a distribution from the plan yet if still in service and younger than 59 and a half. There is no distribution event in most of these cases. And so the defaulted loan is taxed, perhaps subject to the penalty tax, but is not a distribution that is eligible for rollover. On the other hand, if a loan's defaulted as part of or in conjunction with a separation from service event or other distribution event, the unpaid balance may be treated as a plan loan offset rather than a deemed distribution. Now, a plan loan offset is eligible for rollover because the default and the right to the distribution usually occur at the same time. So that's the good news, and the IRS confirms that plan loan offset is eligible for rollover, and that's the good news. And in the past, if you defaulted on a loan and were also entitled to a distribution from the plan balance, you could roll over within 60 days. It was treated just like any other distribution event from a qualified plan. If you replaced the money that was defaulted on the loan, you could make that default tax-free as long as you deposited the defaulted amount within an IRA or into an IRA within 60 days of the default. So that was the little bit of good news under the older rules. Now, as a result of the Tax Cut and Jobs Act, you've got the ability to make the deposit by the due date for the return for the year in which the default occurred. And so, in theory, if somebody defaulted in January of 2018 on a plan loan, and it was a plan loan offset, the Tax Cut and Jobs Act made it possible for the individual taxpayer to replace the money in their traditional IRA as late as the extended due date for the 2018 return, which is theoretically October 15th of this year. And so it's a much more liberal deadline for performing a rollover of a plan loan offset. So that's good news for a lot of our taxpayers who perhaps failed to pay back a plan loan at the time of termination of employment. They've got an extended due date for making it a tax-free rollover. Let's move on to the next topic. Let's talk about the changes to the kiddie tax rules. And so a little bit of background here as well. One of the techniques that families use to keep more money to reduce their overall family income tax rate is to transfer income producing assets into the hands of family members who have less income. And for a lot of people, that has meant transferring income producing assets from the parents' hands into minor child's hands, so that more of the income is saved in the family. And so in the past, the federal government created the so-called kiddie tax rules that were designed to keep this from being a big thing. And until 2018, the unearned income of a child was likely to be taxed at the parents' federal income tax rates. So the parents ended up including most of the income on their own return, and it was taxed at their own rate. Now, what changed as a result of the Tax Cut and Jobs Act? Well, the general rule under the Tax Cut and Jobs Act is that instead of the investment income for kids being taxed at the parents' rate, they're now taxed at the trust income tax rate. And trust income tax rates hit a 37% tax bracket at pretty low income at $12,750 in 2019. Anything in excess of that gets taxed at 37%. And so that's a less generous result for families who are trying to shift a lot of income to the kids. So when does the kiddie tax apply? Well, it applies if the child is younger than 18 at year end and has at least one living parent and is unmarried and has unearned income for the year in excess of $2,100. If all of that is true, the kiddie tax rules apply, and in general, the trust income tax bracket is going to apply. It could apply, the kiddie tax rules could apply if the kids up to age 24 and are dependents and are full-time students. One little nuance is that parents still have the option to claim a child's income as their own in certain circumstances if the child's gross income is less than 11 grand in 2019. So there is still the ability to use the old rules for kids who have more than the minimum, but a relatively small amount over the threshold of the minimum. So the parents' tax still might apply, but in most cases, the trust taxes are going to apply. So let's move on to the third thing. Let's move on to the loss of the potential deduction for wrap fees or investment fees. So again, a little bit of background, a little bit of setting the table is necessary here. Remember that the Tax Cut and Jobs Act substantially increased the standard deduction. Used to be $12,700 for a married couple. It was almost doubled, and in 2019, the standard deduction is $24,400. What does that mean as a practical matter? It means that fewer people will itemize deduction. They will choose instead to claim the standard deduction. As a consequence of that, itemized deductions for some taxpayers will become less valuable. As fewer people itemize their expenses, itemized deductions will be less valuable. Now, to further lessen the value of itemizing, the mortgage interest deduction and the state and local income tax deduction have been significantly curtailed. We've talked about that in other webinars. But to exacerbate that situation further, the miscellaneous itemized deduction subject to a 2% of adjusted gross income floor, that's been eliminated. And that's the category that most wrap fees ended up in. Taxpayers have been able to claim in the past, 2007 and earlier, a deduction or a potential income tax deduction for an investment account expense, sometimes known as a wrap fee. The wrap fee has been subject to, it has been a miscellaneous expense. It's been subject to the 2% of adjusted gross income floor in 2017 and earlier. Well, that ability to deduct the wrap fee is now gone because all the miscellaneous expenses subject to the 2% floor have been eliminated, including the wrap fee expense. And so a lot of the people who call us at Advanced Underwriting Consultants are people who are collecting a wrap fee on behalf of their client. And sometimes the question goes like this: well, I'm managing both qualified IRA monies and non-qualified assets for my client. Can we simply take the wrap fee from the IRA and make all of the deduction being paid for the wrap fee from the IRA, can we make it all pre-tax? And the answer to that is, well, if the fee for managing the IRA account is coming out of the IRA monies, that's probably okay. That probably works. That can probably be a pre-tax deduction from the IRA. But if IRA money is being used to pay for after-tax accounts under management, that's probably either a taxable distribution or a prohibited transaction if money is being used for non-IRA purposes. And that doesn't really work. And there are some private letter rulings that are kind of alluded to as part of this, as you can see in the slide. So the ability to charge a wrap fee, that's still there, but the potential tax advantages or the tax advantaged ways to pay the wrap fees for most of our clients, that's gone. And so that's something that is part of the Tax Cut and Jobs Act that was kind of hidden that you need to be aware of. So what are the conclusions that we can draw from the three things that we're talking about today? Well, it's mostly reminders that the scope of the Tax Cut and Jobs Act is broad. There are a lot of nuances here. We're going to be answering questions about it during the coming year and into the future. The changes, the big changes, personal federal income tax brackets, business federal income taxation, those are big changes that are going to affect a lot of our clients, especially our most successful clients. And so we have an opportunity to go talk to our clients about the changes, including the three additional things we talked about today, to alert them about what's changed. And we also have the opportunity to talk to our clients' advisors about planning for the future and planning in a way that will help our clients to be able to keep more money. So it's a tremendous opportunity for us as we move forward. We should treat it as such. And we hope you find the information that we presented today helpful. Now let me turn the program back over to Jennifer to wrap this up. Jennifer?
Thanks, Linus. And thanks for joining us today. And please join us next month on March 6th for Trust as a Beneficiary of a Qualified Account. As a reminder, if you would like to receive supporting materials about today's presentation, please feel free to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar to us. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.